Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
This is Bazaar Morning Call, live from the CNBC TV18 headquarters in Mumbai.
Welcome to Morning Call. That was a revolution that was unleashed yesterday in Indian corporate history. It's never been done before that promoters who are defaulters will have to simply walk out of their companies. They lose hold. Promoters probably never thought this will ever happen in Indian corporate scene. Probably the sun will never rise in this fashion is what they thought. But this is a clean break with the past. This is putting crony capitalism on notice. This is putting even failure on notice, and some people may think that's going far, but this is a revolutionary change. Good morning. Welcome to Morning Call. Morning, Surabhi.
Good morning, Lata. We have lots to talk about as we gear up for the Friday trade. It's been a very range-bound week so far, but there are big factors lined up today. So we have to look at global cues. Of course, the SGX Nifty is very quiet. We're going to spend some time talking about China and what's happening in Asia in just a bit. Let's just pull up the mainland Chinese markets to record what is going on. There's about a 0.25% decline there. Hong Kong markets are also off where they were about half an hour back. We'll come back to China in just a bit. But first, this big, seminal moment for India, as you have been pointing out, Lata. So we were discussing this yesterday, whether that's a comma or whether that's not a comma. If it's a full sentence, it turns out it is a comma, which means that promoters cannot take control of their companies back.
Yes, I mean, we saw it coming, but we weren't sure the government would go this far. We were wondering if the category would say willful defaulters whose promoters are NPAs, whose assets are NPAs for 1 year. But it's not that. Willful defaulters can't apply. Promoters who have NPA companies for 1 year cannot apply, and a whole list. But yes, it's revolutionary. Immediately, the bankers are a little worried that the number of bids that will come for their assets could reduce a bit. The promoters would have raised the level of the bid. But that said, I think we should be willing to pay this price, if at all there is a price to be paid, because I think this is, in the longer term, cleansing the banking system and the corporate system of what was perceived as very clearly some people playing fast and loose with depositors' money.
No free lunch. The message is loud and clear. But just in the very short term, Lata, do you think at all there could be a minor negative reaction on bank stocks, particularly the big corporate lenders? I mean, just in terms of sentiment.
I wouldn't be surprised, but there are other reasons to do that, and that is the other reason I want to come to what's brewing in China.
Oh yes, absolutely.
Over the past 1 week, bond yields in China have been rising, and that's because there is a major cleanup over there. In the shadow market, China's banks lend to their local bodies and other companies. And the point is, in China, you're not always lending to a private corporate sector. You're lending to government all the time. It's government companies, local bodies owned companies, state government owned companies, central government owned companies. So the point is, this lending by mutual funds, by NBFCs, is seen as getting just over leveraging, borrowing from the banks and lending. So what the government has done is, it has said that there is a limit to leverage that mutual funds can do. You can't borrow and finance. Now that has sent yields on government paper up by about 30-40 basis points just yesterday, and that's government paper. So it's that much more when it comes to commercial paper. This will impact the stocks because it becomes expensive to finance borrowing. And so there will generally be a problem. But I'm not very sure whether that will have a huge impact. Yesterday, it was a 2.5% fall in Chinese stocks. But today, it's kind of started quiet. As you pointed out, it's a 0.25% or so. Yesterday, you could hear the ripple even in Europe and US. But it looks like it will be more a China problem. Our yields also strengthened to 7% yesterday. We thought the Reserve Bank had, brought it down all the way to 6.9, but yields rose. So there is a Asian fear of yields rising, which again will be negative for our banks. But the overall sense we get, speaking to experts, is that this could be a local China problem and won't erupt like in 2015. The yuan depreciating and creating mayhem. That's unlikely. it's probably a day's or a week's problem.
Sure, fair enough. I mean, I think the bulls would really take that and would really want to believe that. However, just some numbers that caught my eye on China in the morning, and perhaps worth keeping in mind, that the margin debt levels, basically the amount of money you're borrowing to invest in stocks, so that number has reached the highest it was since January of 2016, when the Chinese meltdown actually happened. So debt levels are generally very, very high. Also, speculative trading in Chinese stocks is reaching those levels once again. So that could be a bit of a worry factor. The other bit, as Lata pointed out, the rise in the yields, particularly on corporate paper. There's, I think there are bonds worth almost $1 trillion coming up for redemption into over 2018 and 19. So the bond worries, as you highlighted.
But I think the elephant in the room is what we have to discuss.
Which is, will they or won't they? After Moody's, back home, that's the big other talking point, given all that's happened here in India. So, Lata, what is the sense? I mean, what S&P might do, and even if they do, because I'm talking purely from a stock market point of view, Moody's was a one-day event. Yeah. Will S&P be any different?
Well, it's a very important event because S&P is more highly regarded. And when two rating agencies upgrade you, there is cause to cheer. We have to, we were so taken away by the Moody's rating. When we got the rating upgrade in way back in 1994, we went from speculative grade to investment grade. But after you are at BA3 and you go to BAA2, you are within the same investment grade, moving one notch. That's not as revolutionary. Now, what happens? What can S&P do? S&P can keep the rating completely status quo with a stable outlook. I think that is the least likely. S&P can keep status quo, that is BBB minus. Their equivalent of BAA3 of Moody's is BBB minus. They can keep it at BBB minus with a stable, but they can upgrade the outlook to positive. So BBB minus positive, that will also be seen as important because what it means is that we are putting you on notice for a possible upgrade. And usually within the year, the upgrade comes. That's what Moody's did to us a year ago. They put us on BAA3 positive, which means we are watching you for 1 year and seeing if your finances improve. Then we will give you an upgrade, and they had to give us. Now, 1 year down the line, either you have to give an upgrade or you have to come back to stable. Moody's found that the situation has improved. So having put you on positive, they had to upgrade you. S&P may bring themselves to that position today, just say BBB minus, but positive. The best positive will be if they say you are already BBB and not BBB minus, which is a rating change. If that happens, I think there will still be all-round cheer because S&P is a more austere, more demanding rating agency. And I think 10,500 will come like that.
Well, the bulls will take that, and how they have been slugging it out last 4 days. Absolutely range-bound move. No clear signs of a breakup, though we have been making higher highs since Monday. So that is a positive sort of that perhaps.
I thought you were also brewing through the numbers, a small FII positive number.
Minor positive FII number, and of course DII buying continues. So the fund flow support is there. It's a question of getting that break, and I think most of our technical experts have been saying that looking at the way the setup is, the chances of a break on the upside seem to be a little higher than the downside. Well, on that note, let's quickly take a look at what the wise experts have to say as we get into trade this morning. In his weekly blog this morning, Chris Wood of CLSA urges investors to ignore the short-term noise and focus on the long-term positives represented by the introduction of GST. He says, in Greedon Fear's view, it is correct to assume that most of the teething problems arising from the implementation of GST will be sorted within 6 to 12 months. Chris Wood adds that if Modi remains well positioned, the rest of his first term in office is likely to be focused on generating jobs ahead of the April-May 2019 general elections. There are 3 areas where Modi hopes to generate jobs growth in the next 18 months. The first, and by far the most important, is the ramp up of affordable housing under Modi's Housing for All by 2022 policy. The pickup on the ground in affordable housing may not become really visible until late 2018, but the ramp up is definitely coming, which is also why Wood says that investors should look to buy any pullback in stocks geared towards affordable housing. And here is the most important line from his post. Affordable housing in India remains one of the most straightforward bull stories in Asian equities. So the region as a whole, he is very bullish on affordable housing.
Yep. I guess the promoters can't buy NPAs came too late. One would love to hear what Chris Wood has to say about that as well. All right, money market views important today because yesterday the 10-year went to 7%. Bhaskar Panda of HDFC Bank says the dollar had lost some sheen yesterday after the FOMC minutes sounded cautious about inflation. In Indian markets, the rupee gained on the hopes of a favourable S&P decision after Moody's upgraded India's ratings. He expects the USD INR pair to trade within the range of 64.50 to 64.70 against the dollar, with a further appreciation bias. That's because of S&P.
Okay. Well, on bonds, Bhaskar Panda adds that the benchmark 10-year has cooled off, of course, from the high of 7.02 yesterday. For today, he is expecting it to remain in a very, very narrow range of 6.98 to 7%.
Okay, we will come back to whether S&P will upgrade, whether S&P will keep it a status quo, what will happen if promoters can't buy, all those domestic questions in a minute. For the moment, it's Asian markets and the Chinese markets that grab our attention. Following a relatively quiet overnight trading session as US markets remain closed for Thanksgiving holiday, investors are keenly watching Shanghai this morning, which is trending lower after a tough session yesterday. Ben B of CIMB Securities has joined us on the phone line from Hong Kong. Good morning, Ben B, and thank you very much for joining us in what must be a busy morning for you. The Chinese bond yield rise, was that a one-day or a one-week affair, or are we going to see it simmer?
Good morning. On the China bond market, yes, actually the 10-year treasury and the other treasury, actually the bond yield increased a lot in past several weeks. I think there are several key reasons to support that. One is the overall macroeconomic theory to date, which is much better than people's original expectations. Even though people believe that there will be some deceleration in the fourth quarter, but it will be a mild deceleration. So there could be the year-on-year rebound overall 2017 compared to 2016, which is out of people's expectations. So that is, fundamentally, we have some support. And secondly, actually, due to the supply side reform and NL reform and commodity price rebound, so there are some expectation of the inflation to pick up in next year. So the PBOC recently actually the tone changed a little bit to the pocket side, which also leads the investors in the bond market believe there could be some further upside for the treasury yield from what we see now.
Okay,
and then the other side,
Ben, allow me to come in over there. I think we have you on a little bit of a difficult, scratchy line. We do have more questions for you as well. So let's get back to our conversation with Ben B of CIMB Securities, who is joining in to talk about exactly how the Chinese market is shaping out today. Ben, first of all, this rout that we have seen in the bond market, it spilled over to the equity market yesterday. Do you see this continuing, or was it a transitory event?
On the equity market, there's actually quite a few newly regulations from the regulators on equity side, because they're actually tightening the bank asset management and the trust asset management side. Actually, that's actually shaken a bit, and on the investors' sentiment to some extent. Okay. On the other hand, actually, the rising treasury yield, which also deliver the concern to the investors that are we entering monetary tightening cycle and a regulatory tightening cycle. So actually, and ultimately, we have to say that both the China Asia market and the Hong Kong market, they actually performed quite good, especially those the big blue chips. And there could be some profit-taking pressure by the year end.
Okay. So you would say that this is just routine profit-taking and we shouldn't worry about a very big meltdown?
My view is that I do not think the central bank will be very hawkish from now, given actually the fourth quarter, despite it is still quite stable and strong, but it is still a slight deceleration in terms of the growth. So my view is they will do some regulatory tightening as of now, because but if the deceleration of the growth further continued in the first quarter next year, we will see that the tone maybe slightly tuned again.
from the central bank. So I do not believe that it will be a continuous, very hawkish stance from the central bank as of now. So I still believe it is temporary.
Okay, so Ben, you don't see tightening from the central bank, but what about additional regulatory crackdown on speculative trading, both in the bond and in the equity market, with these margin debt levels really soaring? Is there at all a fear that there's some sort of a bubble and there could be more regulation coming the market's way? Could that lower the market's performance?
I think that actually all this kind of regulation has been expected by the market for a long time, because that has been mentioned in the central financial conference in mid of the year. But just people are waiting for the detailed implementation and the policy coming out. And the actual result is not that bad compared to the market expectations. It is marginally still to the slightly negative side, but I think people have been prepared for that.
Okay. All right, Ben. Thank you very much for setting our minds at ease, as it were. Such regulatory tightening was expected, and in fact, the regulations are not as tight as the market was expecting. As well, if yields got tighter, the Chinese authorities, monetary authority, may actually ease things up a bit and will not endanger growth. So this could be just a transitory problem.
Right, that's China for you, though the mainland markets are still under the weather this morning as well.